Hey everybody, it's Larry Berman here, back in very cold Toronto compared to relatively cold Florida. So, another very interesting week in investment markets where end to end, not a lot happened. In between, there was a lot of data points. And to the Bitcoin lovers out there, congratulations on the launch finally of your ETFs. Us here in Canada have had them for many years now, and they've proven to be very, very good vehicles for the average investor to get exposure to the asset class. But make no mistake, I'm not a supporter, I'm not a fan of the asset class, and I'll talk a little bit more about that today. But first and always, let's have a look at the chart room and see what we learned this week. Volatility to start the year picked up. As you could see, the VIX in the first week of the year jumped up, and it looked to be creating a bottom and a breakout pattern, meaning high expectation that vol would pick up. And of course, this week, we saw that cool off and a bit of a rally in equity markets, or a continued rally where volatility, came back down. But, as of Friday, we saw a little bit of an uptick in vol, rip through the market about midday. There was a rumor or confirmation or speculation of a very, very large buyer of 1 month 17 strike VIX options. So somebody made a really, really, really big bet on something bad happening to markets over the next month or so. Maybe that was a tail bet, maybe not. If you look at where volatility was prior to the last quarterly refunding announcement and the Fed pivot, so October 31st, November 1st, to where it is now, that 17 strike is kind of, right there. So, expectation then over the next month, which covers the QRA and the next Fed meeting, kind of sets us up here for the Fed really pushing back on the idea of rate cuts. Saw a headline today where Bill Ackman said the Fed's going to get more aggressive cutting rates. So it's kind of interesting to see the debate in markets today. Probably it wasn't Bill Ackman that bought a little bit of that tail risk support today. Apparently they paid $16.7 million for it. So clearly a position governing a multi-billion-dollar portfolio if they're spending that kind of premium on it. Geopolitically, things obviously getting worse. Woke up this morning to, the aftermath of US and UK hitting targets against the Houthi rebels in Yemen. Oil prices spiking up above 95, and by the end of the day, big reversal. So why can't oil markets hold a bid here, given that, supplies being constrained by OPEC? You've got, now ships having to travel longer, and obviously demand for oil would go up, etc., to run those longer routes around the Red Sea and so forth. You got to think the message from oil here is hard landing. Like, at least I do anyways. But at the same time, you've got Canada and the US producing the most oil they've ever produced. You've got new players that were not there before, like Venezuela coming back onto the world markets, and on the other side of that, potential further sanctions against places like Iran to get some of their barrels off. You've got talk of Russia possibly cutting supply and then you've got this natural strategic petroleum reserves starting to be rebuilt. And so you've got this natural base under 70, probably because of pure supply and demand. But the fact that oil can't hold a bid when the geopolitical tensions in the Middle East are so high is telling. I do think the war in the Middle East expands and gets worse, and possibly attacks, I hope not, but possibly attacks in Iran as it escalates, where Israel and Hezbollah get into a hot war on that front, and possibly the US and UK, back support. Clearly what's going on in the world, in the Middle East, is a humanitarian catastrophe on many, many levels. But again, see this getting a lot worse before, it gets to the table where there would be more of a peaceful resolution. So that, unfortunately, but again, from a market perspective, why can't oil hold its bid? Which is interesting to me. So I think I'm a buyer of dips of oil here for that eventual, move, but really very, very surprising. In terms of inflation data this week, we saw both the CPI surprise to the upside and the PPI surprise to the downside. The messaging there, in my read of it, and things I've read from some others, is that the economy's at full strength, the demand side is there, so the end goods products are going up still, wages strong still, but the goods side is correcting still, and for the most part, the U.S. remains in a manufacturing contraction. So it's not too surprising to see PPI come down and CPI go up because of those dynamics. At the end of the day, CPI is more important, but if PPI continues to fall, it underscores the nature of a weakening global economy. When we looked at the beginning of earnings season and you hear comments from some high-end retailers where they say starting to see a little bit to be concerned about at the high-end retail, and you hear Jamie Dimon's comments that we're still pretty good, but loan losses are going up in these areas and provisions. And so all of that mix, again, to me, it's very, very cautionary. It's not a reason for the S&P 500 to break out to new all-time highs here. But we've had a couple of opportunities in recent weeks for the markets to sell off, and we're right back at the highs. So, there's this underlying bid to the market. It's levered off of Fed policy and the expectations for a soft landing, for a perfect landing, for a Sully landing, and for all good to come everywhere. And again, I just don't see that outcome. So can the market break out here? You bet it can. Positioning now is a lot less favorable for the gamma squeezes, from what I'm hearing from the guys who watch vol and monitor the Vanna and gamma kind of factors that can drive a lot of the zero DTE options and the general hedging flow. So hearing that's turned from a big positive to a little bit more neutral. As always, data dependent. So now into earnings season, it's going to matter. And the bar to me is set pretty high in terms of not just beating, but beating and upgrading the outlook. So if you beat and you beat on cost and you're cautious on the outlook, that matters. We always know about sell the news. And so a lot of good news is priced into the yield curve, into the rate cut scenario, and are they going to be pushing it back? So TBD on that, and the next month or so for markets will be very interesting, including what Janet Yellen does with the colossal amount of treasury supply that's coming. 10-year auction was a little sloppy this week, but the 30-year was pretty tight. So what does that mean? It means there's a underlying demand for duration. The PPI report comes in, long end sold off on Friday a little bit, front end rallied. There's not a lot here that gives me confidence about anything when we're trying to interpret the price behavior. And then we'll close on this note for the crypto aficionados out there. So here's a 3-year picture of crypto. A lot of talk about getting back to these highs on the launch of these ETFs and a lot of money going in. And so what happens this week? Major reversal pattern. So there was a lot of buy the rumor. What we saw was sell the news. We'll see what happens. But God bless those innocent retail holders compared to the big whales that control the space here and everyone else trying to clip out a couple pennies. Folks, this is the most volatile asset class on the planet. I don't think it's ever should be part of the average person's portfolio. I'll agree with Jamie Dimon there. I don't often agree with him. I'll agree with Gary Gensler that this is for speculative investing only. And by putting it in your portfolio, you're adding volatility. The idea that it's uncorrelated and it's a hedge and all those things is complete and utter nonsense. It's worth ultimately what the next person's going to pay for it and not a penny more. Have a great week, everyone.